Good morning and welcome everyone. It is Wednesday, April 8th. This is Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, taking a look at the action yesterday, I tell you, I wasn't very excited by the way the action deteriorated throughout the day. We opened up early in the day, pulled back, rallied back a little bit, put in a double top, and then we saw selling throughout the rest of the day, closing on the low. It certainly looks like a reversing candle, and it's up in that key Fibonacci area. We're going to look at some charts in just a couple minutes. But that reversal in a key area of resistance, I think, could have marked a short-term top. It's going to be very interesting to see today. Futures are up a little bit. They were mixed overnight, kind of fluctuated between positive, maybe 1.5%, down to negative, maybe up to 1% or a little less than 1%. But it does look like, last time I checked anyway, it did look like we were set to open a little bit higher. I'm looking in pre-market action right now. The QQQ is up about 0.8%. When we look at the spider right now, it's up about 0.9%. So it does look like we're going to get off to a good start. What we don't want to see is another big day of selling where we finish down on the lows. What we'd like to see from a bullish perspective is actually a breakout. Now, whether or not that occurs, we'll have to watch throughout the day to day. But certainly to start things off, looks like we're going to move back up into that range where we were yesterday. We'll see whether or not the selling kicks in again. Let's go ahead and take a look at what transpired yesterday. And right here on the chart, I've set up in Candle Glance a 30-day, 60-minute chart. So this is an hourly chart. I think yesterday and the day before I was using a 5-day, 10-minute chart. So I've kind of stretched it out for 30 days so you can get an idea, because what this looks like to me, at least in the short term, if you're familiar with a bearish wedge, or maybe I don't do a whole lot of Elliott wave, but this is more like an ABC move off of the move low. So you can see the Dow Jones coming down, setting the low on March 23rd, rallying. This would be A, pullback would be B, and now we're making this break to the upside, which would be C. So this is a counter trend move back to the upside. And if you look at this as a wedge where you connect these lows and these highs, you can see it's kind of like a squeezing piece of pie. If that breaks to the downside, that would argue for more movement to the downside. And the fact that there is a bearish wedge in play right now, I think probably most technicians would agree that the odds are greater that we're going to break to the downside. Personally, from a technical perspective, I would really love to see a double bottom. Go back and test that March 23rd low. I'm not sure if we're going to do that. I'd like to see it. I would feel better about being long the market if we go back down there and test it, maybe even break intraday or intra-week below it and then come back up. Take a look and see what the volatility index is doing at that time, see what the equity-only put-call ratio is doing at that time. I think we'd have certainly levels of fear that could mark a major bottom. That would be the best case scenario. In my articles over the weekend, one of them I talked about making the bullish case for equities. And one of the things I pointed out is that, everyone is expecting the market to roll back over and move lower, or at least go back down and for a double bottom. And while, technically that may set up, when you think about herding and the effect of folks being, all on one side of the trade, or thinking that the market can only do one thing, a lot of times the market, those participants get the market wrong. Everybody's on one side of the trade, so everything goes the other way. So when everybody's thinking bearish thoughts and the market has to go back down, that makes me think that, well, maybe I should be considering the alternative that the bottom's already in. So this area of the Fibonacci, and I'm going to talk about that. I'll show you the Fib levels in just a few minutes. I think this is going to be a pretty big bounce. What happens from here I would say over the next couple of days to week or two, I think is going to really be important in terms of shaping what we have going forward. I think that the economy is going to get hit hard, already is getting hit hard, but I think it's going to bounce back very quickly as well. And so I'm growing less optimistic that we're going to go back down and test this bottom. I'm thinking, maybe it could be not a V, because I don't think we're going straight back to 3,400. Maybe I'm wrong, but that would just seem like that's way too bullish for what is going to be hitting us, and still the uncertainty of what might happen in the fall. Even if we, in a best case scenario, get the virus under control and we can relax some of the social distancing measures and business starts to pick back up again, to think that this fall everything's going to be perfect and just the way it was last fall, I think probably is not the best way to look at the economy going forward. It seems to me like there's still going to be some uncertainties out there, and the market's going to price that in. So just to get back to 3,400 seems like a stretch on a straight move back up. However, I think as time goes on, I do believe that we're going to head back toward that 3,400 level and above. I think we're going back to all-time highs. This is a short-term condition with the virus. Yes, there are still uncertainties out there. I think it's not a certainty, but I believe most experts would agree that this time next year, we're probably not going to be faced with this crisis any longer. So this is a window, and how the market trades from, during this window is hard to say. We don't really have a sample size. I can't go back and say, well, the last 10 pandemics we had, in this kind of an environment, in a secular bull market, this is how it played out. We don't know. So there's a lot of stuff still that is very uncertain, but I do think when we get to the end of this, I do feel like we were blessed at least to have a strong economy, a strong banking system. Our financial system is so much better than it was a decade ago. And I think that's going to help us get through this in a better way. I think we're going to come out on the other side better than a lot of folks think. Looking at what happened yesterday, though, you can see the Dow Jones Industrial Average flat, but that doesn't paint the whole picture. The Dow was up 900 points yesterday, came back down and finished down 26. That's a big reversal after a gap up. I think we'd be foolish not to at least entertain the possibility that in the short term we topped. So I think that's the way I'm going to approach the market, is that we established a top yesterday. And the only way I would consider otherwise is if we break above it. I mean, that obviously would negate that thought. But as long as that top from yesterday holds, I think we've established a pretty key trading range now. The lows back on March 23rd, the highs yesterday. You can see across the board, though, for the most part, we were flat. We did get a little bit of outperformance in mid caps. They held on, did finish in positive territory along with the small caps, although on a percentage basis, small caps were not quite as good as the mid caps. When we look at the sectors, you can see materials, energy, and consumer discretionary all did gain about 1.5% or more than 2.5% on the materials. So nice little rally in those three. Utilities unable to break above the highs that we saw at the end of March, however. So that was one of the groups that did not break out. When you look across this, you can see just about every area took out that end of March high. Utilities did not. In fact, we've got multiple levels right here. I actually see off the bottom of this pretty symmetrical head and shoulder bottom, reverse head and shoulder, left shoulder, neckline, head, right side of the neckline, right shoulder, almost perfectly symmetrical with the left shoulder. And now we're moving back up. So utilities trying to make a breakout out of a bottoming pattern. And we could kind of use that same pattern across most of these, but I think it really sets up better on utilities. I'd rather see it more clearly on all the charts, but it really doesn't set up that way. 10-year Treasury yield, let's get an update, see where we are. You know, in addition to the highs being set yesterday, one of the things I've been talking about too is watching the 10-year Treasury yield from about 0.75% up to 0.80%. This is an area that if we struggle to get through and start to roll back over, it's a signal money's rotating into Treasuries, sending the yield lower. If we can break out above this 20-day moving average and get through 0.8%, that would suggest more of the opposite, where we're actually seeing money rotate away from the defensive treasuries, yields rising. And if we can sustain a move above that 20-day moving average, that would be more bullish. That would be more of a bullish picture for equities, because anytime money rotates away from defensive areas, that allows money to potentially move into equities. Now, it could just be moving into cash, just kind of watching to see what's going on. But a lot of times that rotation out of treasuries will find its way into equities. So if you're bullish, you really want to see the 10-year treasury yield moving higher. Let's take a look at the S&P 500. So this is a chart that I've annotated in the past. And I went back, and this is the secular bull market. Now, the secular bull market technically doesn't start until you take out the highs from the secular bear market. So when I start the clock for this secular bull market, it really starts in 2013. I think when you hear people say, well, this has been the longest ongoing bull market, they're referring to back at the low in 2009. The problem is you don't know if that's the low. I mean, just like you didn't know if this was the low of the secular bear market. It looked like it was, but it wasn't, because we never went up and took out those highs from the prior top back in 2000. And then we ended up going back down. So we stayed within the secular bear market. So this 5-year bull market was a cyclical bull market within a secular bear market. Big picture down, short-term picture was up. This actually started a long-term trend to the upside, but we didn't know it until we break above that double top, 2000, 2007. So that to me was the confirmation. When we got through in 2013 and set an all-time high, that was my confirmation that goodbye secular bear market, hello secular bull market, and these secular bull markets can last a couple decades. So when we've seen pullbacks, 2015 into 2016, early 2018, fourth quarter 2018, various pullbacks, throughout 2019, and even this one, which has been extreme. Before you say, well, you can't have this kind of a pullback in a secular bull market. Well, I'd encourage you to go back and look at 1987. That crash occurred in a secular bull market. So I think this is still part of a secular bull market. When I connected these highs, I thought, well, let's go ahead and, first I had, if I annotate this for you, one of the things I was thinking was, okay, here's our secular bull market. I'm going to take it here, and I'm going to drag this, and I'm going to connect these lows right in here. See this low over here, this low. It's like, okay, this is it. Well, 2018, fourth quarter 2018, we went a little bit below that. But then, you can see if you just kind of keep that thing going here, we were holding, once we went back above, everything looked good. So when I first started looking at where we could go during this downtrend, I was looking at the breakout level and then this trend line. So I was thinking, 3,000 would be, doable in a short-term pullback. Once we went below that level and the VIX spiked, all bets were off. And you can see what happened, how quickly we went down another 25% once that level was lost. But I'm going to get rid of this because I don't think that line matters anymore. I think what we've done now is we've gone down, we've had a false breakdown beneath the fourth quarter 2018 low, very similar to what we saw here. We took out that 2004 secular bear market low temporarily. That set the major bottom, and then off we went. I think this is a secular bull market low that took out a key secular bull market previous low. And it looked like we were breaking down and rallying back. So if we go back down and take out that low that was established March 23rd, then I think we've got to consider the possibilities that this is something more. As long as that low holds, I am convinced we're in a secular bull market, and we will be back at new highs, just like we were back in the 1980s. 1987 felt horrible. 1 month we were down, 33%, similar to what we've done in this cyclical bear market. But months later, you couldn't really remember being that low. I mean, the market went right back up. We went to all-time highs. I think we're going to do that, but there is uncertainty, and this kind of a pandemic is somewhat unprecedented. I can tell you in my research, I went back to 1918 and 1919. Things were a lot different back then. We didn't have the global economy that we have now. But the pandemic that we had, from the stats that we're seeing, that pandemic was worse in terms of spread, in terms of deaths. It wasn't as bad in the US as it was around the world, but it was a lot worse in terms of mortality rate, the demographic of who was getting the coronavirus and who it was affecting more severely. It was actually more severe in younger people than it was in older people. It was much different. But in 1918 and 1919, we also had this thing called World War I taking place. So imagine having a world war and having a pandemic where there's a 10% mortality rate. I mean, yeah, it's been fearful here. Don't get me wrong. I mean, it's been awful. But this doesn't really compare, I don't think, to what was likely happening back then. And by the way, it was in the middle of a pretty good bull market. And in 1918 and 1919, the Dow Jones went up 10% and 30% respectively during a pandemic and a world war. So don't let all the fear make you believe that the stock market can't go higher. I think that would be a big, big mistake. So I'm now looking at this. I think that we have come back up again. If we go back down the new lows, we're going to have to reassess. We're going to have to look at that, get that whole puzzle out, look at what's going on with the fear levels, look at what's going on in terms of sector performance, what's leading to the downside, and we're going to have to adjust on the fly. That's what technicians do. You don't just make one call one day and then over the next 5 years, wait for that to play out. Conditions change every day, and good technicians, astute technicians, need to change with those changing conditions. Price action changes every day. Technical analysis is nothing more than analyzing price action and relative strength and intermarket relationships to try to forecast what's going to happen. And so as conditions change, you have to change with them. And so I could be extremely bullish one week and completely bearish the next week. It's just, maybe that's an extreme, one week to another, but hopefully you understand what I mean. We have to continue to figure out what's going on in order to, I think, more adequately prepare for what's likely to come. So when I look at this chart, though, I can see, number one, this is the 5-day moving average of the VIX down here, volatility index, and here's the 5-day moving average of the equity-only put-call ratio. I think it's pretty safe to say that the fear that we have felt during this drop is certainly one of the highest levels of fear that we have ever seen in the market. And when you think about that and you look back to a comparable time in 2008, just remember, history teaches us that when the market is incredibly fearful, when you think there's no hope, that's when major bottoms go in. Major bottoms that don't get revisited again. So I'm going to paint the possibility and the probability that what we have seen over the past 30 days has marked a low that we may never see again. I'm not saying it can't happen. I'm just saying based on history, based on the facts, based on the extreme fear. These were not rational decisions when we were selling at 2,200. That they weren't rational. It was irrational. People were scared. They were petrified. They're like, my gosh, we're going to zero. I've got to save what I have left. I'm just selling, not thinking rationally about what might happen down the road, about what the government might do, what the Federal Reserve's going to do. It's just reacting to all the negative news that you're reading. You know, a month ago, you know, everyone was going to get the coronavirus, and who knows how this is going to develop in the coming months. But it seems like the world is starting to get a better handle on it. Things are starting to slow. Even if the cases are going up, the deaths are going up, the percentage increases are going down. So the market is starting to anticipate that things are getting better. And that's why we're seeing the market bounce. So I'd be careful about getting too bearish. I understand wanting to be cautious, but just understand how these bottoms print. Now, when I look at the VIX and you can see the VIX spiked up into the 80s. It's pulled back. In 2008, when we got down in the mid 40s, that's when the stock market seemed to top back on the move to the upside. So in the rebound, the fear level's been coming down. Usually fear doesn't just spike up and go all the way back down. Usually have little bouts of bounces. So I would expect at least a bounce at some point, and this is when I would maybe be thinking about that bounce. You know, if we keep moving on, here's the NASDAQ 100. I could pull up the S&P, but here's the NASDAQ 100. Yesterday's move to the upside saw the high get up to the 50% Fibonacci retracement. That has been the top in the last two crashes, significant crashes that we've seen. And I'm talking dropping 33% in a month, like we saw in 1987 and like we saw in 2008. Granted, that's not a huge sample size. You know, we don't go through this very often. But in both of those cases, we topped in the 38.2% area to 50% area. Yesterday, we opened right at 50% on the NASDAQ 100, tried to trade above it, and we sold off all day. When we look at a 5-day, 10-minute chart, here was the gap up. We pulled back. We got back up. Didn't quite get to the new high. You saw the selling at the end of the day. We're looking at opening up again today. We need to get back through 8,300 on the NDX. The S&P 500 needs to get above that 2760 level. If I pull up a daily chart and we just quickly eat this. And this won't be exact, but probably right about there. You can see 50% comes in at about 2,800. Now, we didn't quite get up there, but we're in this zone on the S&P 500, 38.2 to 50. Back a couple of weeks ago, I said, if you're going to short this market, have some patience. Allow this rebound to happen. Well, it's been happening. If you're somebody who wants to short, if you're somebody who is looking at the leveraged ETF, like the QID, the SDS, keep in mind it is leveraged. So if you've got a $100,000 account and you put $100,000 into the QID, you have 200,000 short. So if you wanted to short your whole account, I'm not saying that's the way to go. I'm actually kind of still on the sidelines, kind of watching, trying to trade here or there, little pieces. But if your strategy is, hey, we're at a key level, I think we're going to roll over. I think having the patience now, I think, is the time to be thinking about it in these Fibonacci areas. And I would slowly work my way into a position. I think at the 38.2, that was certainly a level where you could have started getting in. Yesterday's open, certainly a level you could have started getting in. If we get to 2,800, maybe that's a level you think about adding. And maybe the 50-day moving average is your stop. If it closes above, you just get out and say, I'm wrong. You got to come up with a strategy. I think waiting, though, has certainly helped the reward risk on the short side. Okay, one thing that I looked at last night, I thought you might find interesting, is I went in and I looked to see what regions, what countries have been outperforming the U.S. during this crisis. And the way I did this is I looked to see which company or which countries on a relative basis to the U.S. have a PPO, a daily PPO that's positive. And when I looked at this, of the 25 countries that I looked at, 6 have positive relative PPOs, meaning that they're outperforming. It doesn't mean that they're going higher throughout this whole crisis. It just means that these areas have outperformed the S&P 500. The first is China. China, the FXI, has outperformed the spider. You can see the huge relative spike, and you can see that relative PPO that is much higher. Now, if we just pull up the FXI, I don't want anybody to say, hey, wow, you said that China's been going higher and it's in a downtrend. It is downtrending, but it is downtrending less than the US. So when we go back and we look at a relative chart, it's outperforming the S&P 500. So it's not that the FXI or that China is going up. It's just that it's going down less than the US. So make sure you understand that, because that's the way all of these are. So I'm just going to show you the areas of the world that are actually outperforming the S&P 500 right now. Switzerland is outperforming. It's pulled back just recently, but a clear outperformance throughout March. Japan And what you're going to see is mostly Asian countries. Japan, big break to more than a 1 year relative high, pulled back, but the overall uptrend has been in place. Now, it could be that the S&P is starting to gain ground and may regain its leadership. But for now, I would say that these are all areas that have been outperforming. Hong Kong has been outperforming. PPO, you can see above the center line. Malaysia. Malaysia has been outperforming. PPO above the center line, relative PPO. And then Taiwan. And that's it. Of the 25 countries that I looked at, those 6 were the only 6 that have a positive relative PPO. Of the worst performers, I'm just going to give you a couple here. Brazil is on the bottom of the list. Brazil has been the worst relative performer of the countries that I looked at. And you can see Brazil on a relative basis. So what does this look like on an absolute basis? It looks like from the beginning of the year, being at 48, we went all the way down at the low to 20. So we were down, I don't know, what is that, 60%? Something like that. 60% at the low year to date. S&P 500 dropped about a third. So you can see Brazil on a relative basis was really getting hit. And even during the recovery, we have struggled. Brazil did not go back up and take out its initial rebound. So even though we've seen it on other indices. So Brazil not doing very well on either an absolute or a relative basis. And the other one would be, I'll give you 2 more. Mexico. Mexico on a relative basis has been horrible. And then the other one that I would say has been India. INDA. India relative to the S&P 500 has been very weak. So I just wanted to give you some strength, relative strength on what's been going on. Now, one other thing, I'm going to get into this more tomorrow or on Friday. We're going to have our war room again on Friday for all of our EarningsBeats members. This is going to be, you need to be a paid subscriber, but you can be a trial member. So if this is something that would interest you, you can go into EarningsBeats and in fact, just show you. If you go to EarningsBeats, just click on here, join today, come down the bottom, $7, and it's fully refundable. So if you want to come in for the next 30 days, check things out, you can sign up here. Very simple. And we will refund you your $7 after like 5 business days or whatever. You'll get that $7 back. So literally it's a free trial for 30 days. And we're going to have a very interesting 30 days ahead. So I hope you'll join us. But looking at the, at this event coming up, one of the things that I want to look for or look at is where the money has been going in terms of industry groups and where it has not. And I've got the timeline broken down, various timelines. So for instance, I know what every industry group, where it was back on February 19th. I know where every group was on March 23rd when the S&P set a low. I know where every industry group was after that initial 3-day recovery. I know where every industry group was as of Friday of last week before we've had this 2-day surge. And of course, I know where they all are, where they closed yesterday. I've got all this on a spreadsheet. I'm analyzing it to see where our relative winners and losers are. And I think this is going to give us a lot of clues as to what we want to do going forward, depending on what the overall market does. If the market rolls over, I'm going to be able to tell you, hey, here's the top 10 groups you want to be looking at on the short side. If the market continues to strengthen and all of a sudden we're breaking above levels that we didn't think we were going to break above, and it's starting to look more and more like a bottom is in, then we're going to be saying, hey, here are the 10 or 20 industry groups that Wall Street is saying we favor. They're essentially endorsing these relative outperformers. And those are the groups we want to be concentrating on. So that is going to be the real thrust of what we talk about on Friday, along with a key chart list that I'm developing right now that's going to put all of these really good stocks within really good industry groups into one chart list so that you'll have literally, you can run scans against what I think is going to be the best group of stocks to trade going forward. So anyway, that's all in store for Friday. Market's getting ready to open. We're just going to run a couple minutes over here. But recreational services, just to give you an idea of what I'm talking about. Recreational services, from the initial top to the very bottom, lost 71.7%. In the 3-day recovery, it gained 68%. But remember, it's gaining based on that much lower number. So when I say it lost 71% and it gained 68%, that doesn't mean that it's down 3%. In fact, the net after that, it was still down 60%. Because remember, that 68% gain is on a much, much smaller number. So it barely even began to scratch the surface of all the losses when it lost 70%. Think about this. Okay, let's say an index is at 100. It loses 70%. It goes down to 30. If it gains 2/3 of 30, it gains 20. So that takes it from 30 back to 50. It's still down 50 from the 100 level. So hopefully you can kind of see that. I know I'm much more from a, you know, I love numbers. So I'm probably painting pictures that some of you maybe aren't seeing, but trust me, when you get a big drop, 70%, and then you get a big rally of 70%, it's not equal. So you've got a group like recreational services, went down 71%, bounced nicely. And then as of when we started to roll over, as of Friday's close, we were still down 72%. We actually had gone down a little bit more on the April 3rd than where we were March 23rd. See where we are here, March 23rd, and here where we are April 3rd. We actually went lower. The S&P 500 was not lower. It was much higher. So we're losing ground on a relative basis. Now, the last 2 days, we've had this huge move to the upside. Recreational services has been one of the best. It's gained 25% over the last 2 days. But it hasn't come close to where it was at its recent high. Look at the S&P 500. S&P 500 is broken out above the prior highs. The recreational services has not. It hasn't even come close. So yeah, the last 2 days gains, thanks, you look at it and you say, wow, this is a group I want to be in. I say this is a group you want to avoid. When you get these bounces, you want to get the heck out or short. So we're going to go through and we're going to talk about all these kinds of relative strength and rotation that's taken place. And we're going to find where Wall Street truly is looking and where that money is rotating to. Because when the S&P 500 goes sideways for a week, what's happening is you've got groups like recreational services. They're not going sideways. They're actually losing ground. And then you have something like the truckers. Let me show you the truckers. Look at the truckers on a relative basis. Money's coming out of recreational services and money is going into truckers. But of the 104 industry groups, do you know which ones are the strongest and which ones are the weakest? We're going to talk about it on Friday, so you definitely want to be there for that. All right, we're going to wrap up now. Let me give you the 3 you must see. I always like to do that. Bear with me here. Okay, so the first one I wanted to show you, and these were 2 of the top performers yesterday, IFF. And the reason I brought this one up, I just wanted to show you, first of all, that it does have pretty strong accumulation distribution. It failed on this breakout above 115 yesterday. We can already see it's trying to get through. I think it needs to get through about 119, 120. In the meantime, these gap downs present opportunities because you do see a lot of hollow candles. But on a stock that's gapping up, I probably would ignore it. I'm looking for companies that are showing strong accumulation distribution, are in good groups, and also are showing relative weakness. I want to see stocks that are down in the first hour to an hour and a half. And some of those are ones that I'm taking a shot on with fairly tight stops. Been somewhat successful. Yesterday I had one RNG that I ended up getting stopped out on, so they don't all work. But then I had one from a couple days ago that, and both of these I pointed out in daily market recap to members. But Horizon HZMP was one that actually, when it was down around 30.50, 30.60, that's when I bought it, pointed it out to members. It came back and closed almost at 32 that day. But if you look at the accumulation distribution, that is what I, was, most impressed with. So HZNP is our second 3 you must see. That's the kind of thing I'm looking for. 3050 to 3075 has been a key area. We're down in that area again today so far. And then the last one I wanted to point out, another strong stock from yesterday, is APD. Now, this is one that's got also a strong accumulation distribution, been hanging around this level. 205 has been a bear for this stock. We're sitting at 204.53. If we could get a breakout above 205, I think it has a quick chance to run up to about 215, 214, 215. Something to look at. Right now, would I buy it? No. You could buy it on a breakout above 205, but if you do that, I'd keep a stop because you can see a lot of tails. So you don't want to get in at 205.50 and hold it until you get back to 185. If you're playing it for a breakout, then I think you got to be prepared to get whipsawed in case we come back down to the downside. What I would prefer is see this stock weaken and get it down closer to 200, the 20-day moving average. And then if it turns back up and makes the breakout, you're in even at a lower level and you can keep a stop in very tight to that 200 level. But anyway, those are the 3 charts for the 3 you must see. Hope everybody has a great day. Going to just give you one quick update on what's taking place here. Major indices up about 1%. That is good news. If we pull up the QQQ and just go to an intraday chart, remember we had all of this selling that took place yesterday. This was not light volume on a daily chart, by the way. If you take a look at, say, the spider on a daily chart or the S&P 500, yesterday's volume on that reversal was much heavier. This is an area where we definitely could top short term. And if we do, then our battle lines are drawn. Yesterday's high around the 2750 area, recent lows 2200. This could be our trading zone for the next few days to few weeks. With that, everybody have a great day. Be back tomorrow over at Stock Charts TV for Trading Places Live. And don't forget, Friday, you want to be in the war room with us. Again, I'm going to go through a lot of different trading strategies, industry groups, some of the things I pointed out. Would love to have you. 30-day, essentially free trial. Pay $7, get it refunded to you. I'd love to see you there. Everybody have a great day. Happy trading.